It doesn't take a lot of brain power to figure it out that maybe the yellow line shouldn't be where it is and should be priced drastically higher if we're going to see a world where AI is going to take shape. And it's like the AI is this is the irony. AI is extremely deflationary, but in order to get to that deflationary aspect, we're going to need to build a lot of things, data centers, electrical grids, and so forth. And that's where the irony is, because it's highly inflationary at first. And so it makes me even more bullish in commodities overall.
Hello, Gold Silver family. Alan Hibbard here with another video. And today I'm joined by Tavi Costa of Crescat Capital. Tavi, how are you doing?
I'm great, Alan. How are you?
I'm great. Thank you so much for being here. I'm glad we could finally connect. I know you've been on the show many times with Mike Maloney, but this is the first time that you and I are doing a show together. So thank you for being here. I'm very excited. For this one, I've put together basically some of your recent tweets. You've got a lot of awesome charts that you've been putting out on Twitter lately, or I guess X it's called. So yeah, I thought we could go through some of them and you can sort of elaborate on some extra details that maybe aren't so obvious to people who might see these charts. So the first one I have here is the S&P 500 performance by sector. And you say here, when the generals lead, but the soldiers don't follow. Of course, we see tech taking off big time and the rest is sort of lagging. Tell me about this chart.
Well, this has been the story for the last few years, if you think about it. And technology has been basically attracting most of the flows of capital for a lot of reasons. I think this is more of a function of the fact that we've been sort of operating in a low cost of capital environment, and people have been valuing technology companies in particular with crazy valuations, highly inflated. It's very similar to the tech bubble environment. In fact, if you look at a lot of different things, that you might have even a chart of the weight of the technology space relative to other times in history. But this is really the problem, is that when cost of capital starts to really establish itself at higher levels than we've seen historically, what tends to happen is that we will probably see a repricing of valuations, and technology is probably going to be at the core of that repricing. And in my view, we're probably going to be discounting the present value of these companies at much lower valuations, and this is going to have an impact in a lot of things. And so, there's a old saying that the pendulum can swing until a certain point, but it can't be going forever to that in which capital continues to flow as extreme as it has been. I mean, people have been allocating capital into technology for a really long time. In fact, I think that this growth to value transition is much more likely to happen in the next 5 years, and I think technology will be very impacted by that.
Yeah, absolutely. I totally agree with you. And I think this is the chart you were alluding to a second ago, the technology sector weight in the S&P 500. And you say here that the tech sector made up 34% of the S&P 500 at the peak of the tech bubble. Today, it's 33%, basically the same number. Do you think we are in a bubble right now?
Yeah, I do believe this is a bubble. I mean, and it's, we have other vital parts of the market that have been neglected for a very long time. And in my view, this is just unsustainable, how much of the focus has been in technology. And, I think, what's his name? Senzel, who passed away not too long ago, used to have a good sentence about, great money is made or great returns are made in industries that lack capital, that lack efficiency. And this is completely different from technology. I mean, technology is the opposite of that idea. I mean, there's an excess of capital coming into technology. How can anybody think that they're getting advantage or any type of edge over another investor or any other VC fund or private equity fund that has been navigating the space for so long over those folks? I mean, it just seems ludicrous to me that anybody can be able to really outperform in a space. In fact, recently I've heard somebody saying, how do you they ask me, how do you justify not participating in this market? I think it's pretty simple. It's pretty easy. I mean, I don't feel bad not participating on something I believe it's highly risky and carries a lot of issues. I mean, when you think about how to value a business, you have basically what we do as money managers, we take a business and we think, okay, how much cash flows is that business going to generate in the future? And then we discount that back and we figure out what is the discounting mechanism we want to use. Usually we use a discount rate that is somewhere close to where interest rates are, especially for that company. And then we use a WACC that is so called, but not to be too fancy, that discount rate is essentially how much risk there is to execute in producing those cash flows. And if you think about the technology space today, that risk is basically zero. They're essentially calculating these things at, a 0% discount rate factor. And so there's basically zero risk priced in the markets that these companies are going to execute these crazy free cash flow numbers. When on the other side of things, you have natural resource companies where are highly likely to actually come above expectations on those bottom line numbers, and are actually being overpriced for risk. So that's the classic kind of migration of capital from one side to another that we tend to see in decades, and that causes the shift of leadership that tends to happen as well. So, this is where I think the big story really is.
Yeah, some great points there. And as I look at this chart, one of the main questions that pops out to me is, we look at the steepness of this curve leading up to the tech bubble and how it's not quite as steep currently. I'm wondering if this can go a lot higher and see something go vertical before it goes downward. Any thoughts on that?
Well, I think it's very possible. I mean, as you said, it's been building rather than sort of an exponential growth. It's possible. And I showed a chart the other day of something similar, and somebody made a comment as well. Well, we're probably going to retest that number. What's the risk reward here? I think that's really the if you're able to sustain. The other day Nvidia was down 5%, and today it's up. But the other day Nvidia was down 5%, and this guy said, "What's wrong with buying Nvidia and selling it at whenever we reach the peak?" And when he asked me that question, Nvidia was down 5%. I said, "So is that the peak today or no? How do we know?" Nobody knows. That's the final answer is nobody knows when the right time is to sell. And Sam Zell himself, which I have a lot of respect for him because I think he's brilliant the way he was able to enter different industries at different parts of his career, but really acknowledging times when an industry or a sector or a segment of the market was inefficient because of lack of capital. And he would flip from one side to another very quickly. And a lot of times he was seen as a person who would get out of a sector in an early manner and kind of lose some of those returns at the end of the bubble. And, I think a person who's been able to become a billionaire in the back of those good decisions over time is sort of somebody who I'm trying to replicate personally. And so, to me, that's it's a classic way to do it. I mean, why would I even care about this when there's other natural resource companies that when you think about the way they're being priced, just for a short answer here, a lot of these natural resource companies are actually being priced as a deflation for the natural resource prices and then a massive inflation for the cost, which makes zero sense. I mean, anybody with, a few cells of brain will come up with an idea. Okay, if we see costs inflating, we're probably going to see natural resource prices also inflating. That's the usual aspect of being in an inflationary environment. But the overly, I guess, fear environment that we have coming from analysts and investors that don't know this industries of natural resources very well end up doing that. So that's why we see those very low ball valuation aspects, which I think it's great for investors that are taking advantage of these little opportunities in markets. Much better than trying to, get on a trade to go from 30% of the S&P 500 weight to maybe 40%, which I feel like it's a tremendous amount of risk for what's there for in terms of returns.
Yeah, I agree with you, and a lot of good points there. And I think sort of the main idea is the risk reward trade-off. It's just simply not there. I totally agree with you. Okay, so kind of relatedly, you've got to the tech sector, you've got semiconductors versus the metals and mining industry, and we can see that they were pretty closely linked, certainly highly correlated for several years. And then all of a sudden, semiconductors just taking off, going vertical and leaving metals and mining fairly flat. And you've got an intriguing thought exercise here. I guess I'll read it because it's probably going to be valuable for people. As the semiconductor market expands, it inherently leads to increased electricity consumption, of course. How can we transition to a world where AI, onshoring, and the green revolution can flourish without significantly elevating the importance of the metals and mining industry? This is a great question. As illustrated in the chart not too long ago, the global semiconductor industry and the metals and mining industry had similar aggregate market caps. Today, the semiconductor industry is nearly 6 times larger than the entire mining industry. That's pretty crazy. And this is just 10 years. So yeah, anything you want to add to this?
Yeah, I mean, this chart, by the way, also adds gold and silver, which probably should be taken out of this as part of, if you're just, strictly looking at electricity consumption. If somebody can say that maybe silver comes, should be part of this, but it's such a small amount that it doesn't really matter here for the purpose of this analysis. But the big point is, every day I see Nvidia going up, the first thing comes to my mind is, boy, we're going to see all these electronic components and electronic devices actually being shifted to enable AI. I mean, the amount of laptops and computers and phones that are going to have to be rebuilt just to enable their AI capabilities. And not to mention all the stuff that is probably going to have to happen in terms of the electrical grids and so forth. I mean, Elon Musk had a very good way of explaining this. He sees electricity actually changing in 3 components. It's basically electric vehicles, electric heating, and then AI. And so those 3 things are probably going to be the major aspects that will change society when it comes to consumption of electricity. And if we are in that world, which seems to me, as the blue line presents there, people are increasing the probability that we'll see something along those lines. How do we go there without making that yellow line at least follow, double, triple from here? And knowing that this industry, on top of all this, the timing to build a mine, the difficulty to find a discovery, all these little things that are not little, they're actually vital to society, that I think are not being priced in that yellow curve at all. Not too long ago, I remember thinking about, okay, everyone's so bearish about natural gas. We're seeing all this electricity consumption idea going up. How in the world that's also not going to drive the biggest source of electricity today to go up massively in value because of the demand? And, people are just overly stating the supply side of natural gas. And then all of a sudden that gas turns. And I think that, if you ask me, and it's not that I'm saying I had the crystal ball on that, the same thing is happening right here. It doesn't take a lot of brain power to figure it out that maybe the yellow line shouldn't be where it is and should be priced drastically higher if we're going to see a world where AI is going to take shape. And it's like the AI is this is the irony. AI is extremely deflationary, but in order to get to that deflationary aspect, we're going to need to build a lot of things, data centers, electrical grids, and so forth. And that's where the irony is, because it's highly inflationary at first. And so it makes me even more bullish in commodities overall.
Yeah, I totally agree with you. It's only a matter of time. If AI is going to take off, there's got to be the hardware, made of raw materials, metals, and so forth. It's got to rise to meet the same line. All right, small versus large cap stocks. One of them is lying. I like this one. Part of me almost expects there to be an even wider divergence here, although it still is pretty wide. So you've got the S&P 500 and the Russell 2000, and you're saying these divergences don't matter until they do. I suspect that small caps, which represent 2/3 of the labor market, are likely a leading indicator that the overall market is far ahead of itself. What do you got to say about this?
Well, I obviously think that the red line is not lying. The red line is the real economy, and it's the real economy because of that idea that actually represents 2/3 of the labor market, but also because historically we don't see the red line diverge from the white line for too long. That essentially the red line, or small cap companies, are a huge part of the economy in the U.S. outside of labor markets, just looking from a profitability standpoint as well, and its significance in terms of even the global economy. And so, to me, you can see this chart in many ways. You can look at the large cap versus small cap stocks, but you can also do the same thing with U.S. companies versus the rest of the world. There's a similar divergence happening there. In fact, if you look at the S&P 500, or I should say the Russell 3000, which is the broad equity market, if you want a broad index that looks at small, large, mid cap names, that's the Russell 3000. And less than 50% of the index is below its 200-day moving average already. So now, when was the last time we've seen? And Russell 3000, by the way, is at all-time highs. You know why? Because it's a market cap weighted index as well. So I think that these are important divergences that we have in markets. Clearly, we have breadth of the market is starting to deteriorate significantly. And so, to me, I've never seen in my career a time when we have these divergences, and at the same time, you have a massive suppression of volatility. Across many asset classes, you can see VIX, the volatility, supposedly volatility index for the equity markets. You can see the same happening with oil. You can see the same happening with credit spreads. Which is essentially the corporate bond spread or corporate bond yield spread versus a 10-year yield in the U.S. Or if you look at FX volatility as well, it's very suppressed. So to me, these are all signs that for a general investor today to hedge, to pay for an insurance, it would be the simpler way to explain this, is really cheap right now. And those are usually times when you want to be paying for that cheap insurance, because usually that insurance, it will pay off in the near future. So in my view, I think those divergences are getting a little bit too extreme. And at the same time, given the cost to hedge getting cheaper, to me, this seems like almost like an arbitrage for investors right now.
Yeah, for sure. And that cheap insurance hopefully will pay off, or hopefully you don't even need it. U.S. value versus growth stocks. You've got a rolling 10-year total return difference. And this is a really interesting chart because it goes so significantly negative. You say here, those who think fundamental analysis is dead are likely in for a rude awakening. This recent trend of growth stocks outperforming value stocks was actually an anomaly, driven mainly by lower capital costs that favored growth over profitability. This is a great point. As we return to a more typical environment, like the one from 1936 to 2008, that's a long time, many investors may be caught off guard. Notice that we also experienced a similar but brief period of growth, outperforming value stocks during the tech bubble of the late 90s and early 2000s, that dot-com bubble. The next decade is likely to see a significant resurgence in fundamental analysis and the value-driven approach. So you're really talking about that Warren Buffett style investing versus whatever you want to call what's been happening lately. So you want to elaborate on this?
Alan, this is at the core of my views right there. And the main reason for it is because I think it explains a lot of the other divergences we have in markets. So I'm sure you've seen the chart of commodities to equity ratio, meaning the commodities versus U.S. financial assets. And you can do that including bonds and just the stock market overall. What you're going to find is that real assets are really cheap relative to financial assets today. And you're also going to see that value has been really underperforming growth. The other thing that also is interesting about this is that when you think about the correlation between, if you own a portfolio, which is normally called a 60-40 portfolio, where you have 60% of your assets in equities and 40% in bonds. You know what is interesting about that as well is that correlation of the two is shifting. And the only time that correlation was beneficial for that type of portfolio was also in this brief moment in history. It seems not brief because 10, 15 years, when you're living those 10, 15 years, they seem like forever. But when you go back hundreds of years, the reason why 60-40 portfolios have worked so well is because of these correlations that have also benefited the idea that when equities fall, treasuries go up. And the fact that we've had this, environment of ZIRP, or zero interest rate policy environment, or very low or suppressed cost of capital, which by definition also causes the suppression of volatility that I was mentioning, that creates, an appetite for risk that we haven't had in many years, or many decades, or perhaps even a century, as you can see in this chart. And this to me is something that is unsustainable. It's completely unsustainable. And the main reason for that, it always falls back on the idea of what type of cost of capital we're going to have in the future. And you may say, I can't imagine a world where interest rates can stay high for so long because of the debt environment we have. I want to remind those folks that we also have inflation. And to me, the big thesis is that inflation is likely here for longer. And if that's the case, that naturally causes cost of capital to be higher. If cost of capital becomes higher, value should be outperforming growth according to history. And I'll give you just another example. If you look at emerging markets and you do exactly this chart and you look at the value versus growth of emerging markets versus developed economies, what you're going to find is that in emerging markets, value always outperforms growth. The reason for that is because cost of capital is always higher. Emerging markets are always facing inflation, and therefore their central banks have to keep interest rates higher in order to find some level of stability of their currency. And so, to me, those are very important things. And I think value investing will be an ability that will be in high demand in the future, given the dynamics that we're seeing likely unfold here in the coming decade.
Yeah, it makes sense. And the value investing you're talking about that Warren Buffett has been good at, that has really been the traditional environment for most of the history of the US. And like you're saying, all of history in emerging markets. I mean, that's like a normal economy, whereas this upside down economy where, money is free is completely unsustainable and backwards. So,
yeah. And by the way, if you go to earnings call, sorry to cut you off, Alan, but if you go to an earnings call of a company and you look at the frequency of analysts attending those earnings calls, it's at one of the lowest levels in history. Like, people don't even do due diligence anymore on buying a company. Their due diligence is essentially, chart looks good, probably should be buying this. And, that's the type of market participants we have. They're very they don't know risk very well, because we've seen a world where any issues are being, basically met with more money printing. And if that's the world we're going to live in, and it's going to cause these stocks to continue to, I can imagine that natural resources are going to continue to have been overly penalized for their risk as well. So, it's kind of a world, you go back to that commodities to equity ratio idea, because I think ultimately that's also another interesting chart long-term that will probably unfold. So sorry to cut you off.
Oh, no worries. No, I appreciate it. All good stuff. All right, let's keep rolling. Here I've got the forward PE multiple.
Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer. And now back to the video.
All right, let's keep rolling. Here I've got the forward PE multiple. We've got the S&P 500, and we've got equal weight here. You say gravity is unrelenting and inevitably prevails. The forward PE ratio of the S&P 500 is now nearly as high as it was at the peak of the tech bubble. It's understandable that during periods of euphoria, less experienced investors might claim that valuations are irrelevant, kind of like what we just talked about. I would like to remind those folks that we no longer live in a ZIRP environment, zero interest rate policy. While changes in the macroeconomic regime take time to permeate the financial system, a higher cost of capital should ultimately lead to compression of valuation multiples. Okay, so we've really talked about kind of all these things already. Is there anything you want to add to it on this chart? Otherwise, we have plenty more we can get to.
Yeah, no, there's two things that I think are important here. Profitability is great. If you think about the profitability of the companies we have today versus the technology companies of the early 2000s, you will see that the percentage of profitability of these companies are actually significantly higher than they were back in the early 2000s. Now, profitability comes at a cost, and this is what this chart is doing, is looking at how much am I paying for that profitability, and how much we are paying for the profitability. Future profitability is clearly as extreme as it was during the tech bubble, and to me, that's an important point to take. There's another thing that you said about the higher cost of capital environment. Yeah, I mean, I do think that this ultimately, in an environment, when we look back in history, other periods that we had inflation usually causes the multiple compression of the market. And usually that can be caused by earnings growing, but most of the times is because prices actually have to be revalued and therefore causes that compression of multiple. I think that's highly likely today as well.
Yeah, I agree. And I don't have a chart of the inflation. I really enjoy the one you put together not too long ago, where you've got the 3 inflationary waves of the 1970s, and you've lined up the most recent inflationary wave that we had in the United States. And you said you are here, and you've got it right after the first wave. Maybe Dan can add that in post here. But it's really nice, and it kind of shows that we're in for 2 more inflationary waves. And like you say, that's going to force compression of PE multiples. Things will have to come down to a reasonable level. It's kind of inevitable.
I would agree. And by the permeate, just to mention one thing, the permeation of that in the system is if you think about it, it's really caused by one thing. When you increase interest rates, it takes time for a company to have to reissue their debt, as they have to roll their debt because the debt has matured. And we're right now in the process of seeing some of that debt being reissued. Now, there are miners, gold miners today. Just to give a small example, they're actually having to sell non-core assets in order to pay down their debt, so they don't have to roll their debt at a higher interest rate environment. And that's going to be the case that not just a gold miner will face. Every company will face that issue. And the consumer discretionary space is the most levered it has ever been. And very few people know this. Consumer discretionary is a significant portion of the market. And today it carries the most amount of debt to assets ratio that we've seen in the history of that sector. So that is going to have to be reissued. And we're going to see the changes, the compression of not only multiples, but really margins because of that cost of capital change.
Yeah. So a lot of risk hasn't been priced in, but it is soon. And companies are going to have a tough decision on that one.
Yep.
U.S. versus the rest of the world, price to book differential. So aggregate price to book differential, S&P 500 versus the MSCI World, excluding the U.S. And you say U.S. equity markets have never been more expensive than the rest of the world on a price to book basis. So yeah, this is pretty compelling. We're exceeding levels of the tech bubble. We had a 2021 peak. It looks like we're going to blow right through that. And we've talked about, no one has a crystal ball. We don't know how high it'll go, but we do know that it's unsustainable. It has to revert to something reasonable. So what do you think about this?
Well, since I've been talking a lot about the one side of this, which is the US and how expensive it is, how about we talk a bit about the opportunity? Because the rest of the world is, to me, extremely undervalued. And it's, to me, where it carries a lot of the potential for returns in the near future and the next 5 to 10 years, because a lot of things will shift. And as we see technology, capital coming out of technology and actually migrating into real assets, we actually tend to see economies that are highly linked to the commodity cycle to actually do very well. And there's a lot of economies in this rest of the world index that is being used here that are commodity-led economies that will probably be in a very favorable environment in this coming decade. And when I looked at how much they earn, and you buy a business in the US, especially the technology space, you could be paying, 80 to 100 times earnings in some of those numbers. And in some of those emerging markets that have resource-rich economies, you can buy a bank trading at 1 time, 2 times, 3 times earnings. And so it is a drastic difference. And as you can see here, this is looking at price to book, not price to earnings. But even on that perspective, the rest of the world is as cheap as it could be. And so to me, it's almost like it could be seen as a spread trade for those that want to get a little bit more complicated on how to potentially express that view, but potentially really just looking at being more open-minded to other regions in the world that can actually benefit from that migration of capital that will at some point likely come out of technology and come out of the US and probably flow into other parts of the market.